Guys, welcome to today's video. We're going to cover basically what dollar cost averaging is. And if you know what dollar cost averaging is, it's simply, I guess you could say it's a strategy. It's a financial strategy for you to kind of invest and win in the market and applies to any type of asset that you're investing in. But we see it most commonly with stocks and what dollar cost averaging with stocks is. So let's get right into the meat and bones. So dollar cost averaging. So right here is dollar cost averaging is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of the asset's price. Invest a set amount of money at regular intervals, regardless of the price of the securities. You buy more share of the stocks when prices are low, and fewer when prices are high, reducing the average cost per share over time. Now, what that means essentially is that instead of buying in one lump sum, let's say you invest in Nvidia stock, which is trading around $120 so after the stock split. So instead of, let's say you bought 10 shares of 120, it's $1,200 in one lump sum. You would kind of agree to setting aside to investing $100 per month into Nvidia stock over the course of 1 year. Now, that's regardless of if the stock goes way up or if the stock goes way down. Overall, you're obtaining the same amount or the same dollar cost of the equity of the share over that 1 month period. And then you're bringing it out over a 12-month period. So why dollar cost averaging? Why do some investment professionals advocate using dollar cost averaging? Well, it's risk management, right? Instead of, as I had mentioned previously, if you don't dump these one lump sum into the stock, but you instead do kind of an equal amounts distribution, you're taking out the market volatility, right? You don't know if you're buying in at a very low cost or you're buying the stock at a very high cost. So in that sense, it's removing the volatility aspect or market volatility aspect from the stock. Second is the emotional discipline. So, essentially investing in itself is a discipline. It is a philosophy or is a discipline, right? Because you can kind of get lazy about it and not invest for some months. You can just forego investments. But if you do dollar cost averaging to where you actually program that into your bank account to take out $100 and automatically deposit that into the stock, you're kind of disciplining yourself to be a disciplined investor. Um, Long-term investment. Okay, so dollar cost averaging benefits those who are basically long-term investors. It doesn't really help or assist short-term traders or day traders or those who are looking to make a big a profit on price movements in the market. This is not that strategy. This is a long-term strategy. Now, whether you're invested in ETFs for trading, mutual funds, stocks, it's a long-term investment strategy. So you're not in it to kind of make a quick profit like trading. So in that sense, it is a long-term investing. What it can most oftentimes, it is a good investment strategy, but there are some potential drawbacks. Now, just as dollar cost averaging can kind of take the emotion and the volatility out of it, you're still at the kind of the mercy of the market. So if you're in a really good bull market and the stock is just going up, 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 you may miss on some profit taking by not investing that lump sum, not investing that huge amount and gaining the appreciation on that. So that is a potential drawback. And DCA, or dollar cost averaging, does not eliminate the need for research. You need to still do your fundamental analysis, your technical analysis, your understanding of the key ratios of the stock, where it's going. So let's just give an example for this. I have an example here listed out, and it says you invest $100 in S&P based on index funds every month for 12 months. The price fluctuates throughout the year, but as you can see in the chart, even when the price at the beginning and the end of the year is the same, your average cost coverage price per stock is lower than, and you can make a profit if you sell. So if you commit to investing $100 per month, as in the first case here, you can see the price for that particular stock. It goes up. It starts at 10, it goes up to 12, it goes down to 7, goes back to 10. And it gives you on the right side of that column, it tells you how many shares you purchased with that uh, amount of money invested. Okay, so the overall, you're purchasing 125 stocks, or I'm sorry. You overall invested $1,200, right? The number of stocks that you bought is 125. Now, if you had bought or 12 months at a price of $10, right? The same amount of shares, right? Which is 12 shares. Is that right? Yeah. Yeah. Plus over 10. Okay. Yeah, you bought 100. I'm sorry. You invested $100, right? And it at you bought 12 shares at 1,200. You would have $1,200 invested, but you would only have 120 shares, right? Because 100 the stocks at that given lump sum moment is $10, right? So $10, multiply that by the amount of stocks that you bought at that particular price is $10. So you break that out to 12, and then you get 1,200. So you're actually getting more shares per the amount you invested over dollar cost averaging versus not implementing this um, particular strategy. So that in a nutshell is what dollar cost averaging is. Overall, it just to reiterate, it helps those that are invested in the long term, who are in there for the long term. It doesn't really help the short-term traders or those who are in there just for a short, minute amount of time. Anyway, I hope you got a lot of good benefit out of this. Don't forget to click and subscribe, and we'll see you on the next video.